Happy Labor Day, everybody. Hope it's been a blast for you. Now, let's get back to business. So, September is going to open up. We got two major catalysts to look out for that will decide the next leg up or down for both the markets and the economy. Starting off with a full jobs data report this week. Keep your eyes open for that. And then the Fed's interest rate decision on September 17th. Now, as far as markets go, August wrapped up. It ended up being a pretty decent month for the markets. The Dow seen gains of 3.2%, reaching new fresh highs. The S&P 500 grew 5 new highs, gaining 1.9%, and the Nasdaq grew 1.6%, reaching 4 new highs, all in just this month. Now, the question is simple. Does a likely rate cut that everybody's expecting to happen extend this run that we've been seeing, or do valuations and volatility begin to bite? Now, looking more backwards at Powell at the Jackson Hole Symposium and what was said, he said that policy was restrictive and the balance of risks may warrant an adjustment. Now, read between the lines, because that's what markets did, because now they took that as a green light for rate cuts and are pricing in about a 90% chance of a 0.25% or 25 basis point cut in September. As Ellen Z put it, how far that door opens depends on which risks dominate. And the main two risks the Fed are watching now and have been watching are between a cooling labor market or tariff-driven inflation. And they kind of got to pick one, like we've been talking about for quite a while now. Now, as far as the economic calendar goes, Tuesday we got some ISM data, construction spending. I think everybody's going to start really watching and get back to business on Wednesday with the JOLTS report. So pretty much what everybody's expecting is this forecast of 7.4 million openings. The last reading was 7.4. So this report for July, we're expecting no changes. But what JOLTS is, these job openings, is it tracks how many open positions employers are trying to fill across the U.S. And it's one of the Fed's favorite gauges of labor demand. Now, why this matters is Powell has pointed to the ratio of job openings to unemployed workers as a signal of labor tightness. A steady 7.4 million shows demand is cooling but not collapsing, consistent with softening labor market. It is unchanged though, so just note that. We'll also get the Fed's Beige Book, which is a survey of business conditions from all 12 regional Feds, used for context at the September meeting coming up. And then on Thursday, we get ADP employment. This is another payrolls report, forecast 75,000, down from 104,000. Now, what this does is it measures private sector job growth. No government hiring is included in this, and it's not always aligned with official jobs reports, but it's kind of like a preview. Sometimes they run together, sometimes they're completely opposite. So take it with a grain of salt when you see it. But why this one matters is a big miss or beat can shift market expectations for Friday's non-farm payrolls. But remember, they don't really align with each other. It's kind of just, here's the private and here's the jobs report. Now, Friday is the super big one. We get the official and then we also got initial jobless claims. How could I forget that? So we're expecting 231,000 up from 229,000. This is a weekly count of new unemployment filings, and a steady number here near this $230,000 mark signals no mass layoffs. A sudden spike could rattle markets, but just days before the Fed meeting, it's unlikely to happen. We're probably not going to see that happen, and we got the forecast right here with the last read. It's not really a big spike here. Now, the big jobs report, we're expecting 75,000 jobs, up from 73,000. This is the single most watched labor report, and if this came in weak, a weak but positive number supports a case for a September rate cut. Now, then we also get the U.S. unemployment rate, which is expected to raise a little bit. U.S. hourly wages aren't expected to change. Now, why all of this matters is a tick higher means Powell's weak labor market narrative is kind of at play, kind of what he was signaling at the Jackson Hole Symposium. But if it drops instead, markets could question the urgency of cuts, and the pricing in of rate cuts could simply go away, and they could go away really quickly. Bill Adams says best case for risk assets is a modest payroll growth with a slight uptick in unemployment, not recession, but enough slack to justify a cut. But worst case is falling employment, falling participation, and a lower unemployment rate, shrinking labor supply while demand cools. This combo is what the Fed is least equipped to fix and puts them in a really tough spot. Now, rate cuts aren't automatically bullish. It's why you cut and what happens next. So Powell's restrictive comments means a trim can be supportive if it's normalization and not necessarily a rescue. Shelby McFadden is watching the plumbing though, deposit flows, mortgage rates, and bank risk appetite. If that transmission is slow, the real economy lift lags. Now, seasonality, we're heading into September. We're here, it's September 1st. And remember, we've talked about this for a while. September is a laggard month. The S&P 500 averages a decline of 0.7%. But with the index above its 200-day, Ryan Turnquist notes the average flips to up, so a gain of 1.3% with a 60% rate cut, with a 60% win rate, not rate cut. The caveat here, though, is that the VIX is year lows and often rises late September, early October, and with low volatility, cheap protection, but also dry tender. Now, under the hood, breadth improved. Small caps gained 7% in August. Its best month since November and best August in 25 years. So if that persists, it reduces concentration risk. Julian Emanuel sees a twice-in-a-lifetime tech revolution, internet then, AI now, with broader participation from utilities, industrials, powering the AI build-out. His best-case scenario is a structural bull through 2026. His target for the S&P is 7,750 on 27 times and 287 EPS or earnings per share. A bubble path scenario could tag 9,000. Near term, he still expects some pullbacks, just like a lot of people do, and likes these cheap hedges while the VIX is at these low levels. Now, we got more of a bear case to expect because that was kind of the bull case. We're expecting the S&P 500 to keep on growing at least until 2026. The bear case is more valuation risk and it being real, with the S&P at a record 3.23 times sales and 22.5 times forward earnings per share versus a 16.8% times average. Its top 10 names are 39.5% of the index value, and that's where the concentration risk raises fragility. We got April's tariff shocks showed mega caps can underperform, and if the narrative tilts, crowded trades can unwind pretty quickly. Just like everything's a big old meme stock, and you've seen how these meme stocks trade. It's all up until it's not, and then it's down very quickly. Then rate cuts beyond September. We got Morgan Stanley's rates team is more dovish than consensus on the path. They're expecting a 25 basis point cut this month and similar steps roughly every other month meeting into 2026, with scenarios that pull Fed funds toward this 2.25 to 2.75% range. And they will likely they like these curve steepeners and duration in fives and the long bond. So they were looking more at the treasury curve as far as what I was just talking about. Now I'm looking at my notes real quick. They're talking about policy overhangs. So there's these two overhangs going on with ongoing legal fights over tariff headings into the Supreme Court, which add this fall headline risk as far as what happens with these tariffs and how markets perceive them. Christine Lagarde warns that any losses of Fed independence would ripple globally. And another reason September's event risk matters a ton. Now, here's the discipline setup for the next 2 weeks. We got to respect the calendar risk. We got JOLTS, ADP claims, jobs this week, the Fed September 16th and 17th meeting. Those are all the volatility windows to watch out for. Then barbell exposure, quality growth tied to the AI, productivity, and cyclicals. Industrial utility names, leverage to data center buildouts, keep a sleeve in small caps while breadth improves. Now, price your downside with the VIX low. Hedges are inexpensive, and a lot of people are expecting at least some type of pullback before the year end, especially October. Mark your calendar for that. We don't know if it actually happens, but all we can do is watch what happens. So if you need protection into the event, this event driven trade we're going into, now would probably be a good time to look forward and not after this spike in volatility. But the bottom line is September has a reputation, but momentum, breadth, and a likely rate cut are real supports here. Let the data guide the tone into the Fed. And if we get a standard pullback into event risk, history says, and this is history, not me, that those dips are opportunities, assuming the jobs print says we cannot broken. So I don't know. We'll just watch what happens, everybody. I'm trying to get back into the groove for my extended weekend, but it's been one, everybody. So hope your week's great. I'll see you tomorrow, and have a good one.